Hello, I'm Russ Mould, AJ Bell's Investment Director, and I'm here to discuss the subject of Exchange Traded Products, or ETPs. Now with me is Howie Li of ETF Securities, one of Europe's leading providers of exchange traded products, and we're going to look at a new generation of ETPs and how they could be used to help build a balanced portfolio. Now Howie, thank you very much for your time, to see your expertise. Now ETPs are regularly held up as a great way to get broad exposure to an asset class through a well-known benchmark like the FTSE 100 or the Dow Jones Industrials. But to what degree they can be used to target a much narrower market, or almost a niche as it were?
They're absolutely available to use for some more niche investments. I think if you look at exchange traded products, they're all about access. So let's break it down by asset class. You mentioned some broad equities earlier, but if you want to go into more thematic, I suppose, investments, we've certainly have got products ourselves which perhaps target, let's say, China A shares, robotics and automation investments. We've got gold miners, as well as infrastructure investments such as MLPs. So depending on what you're looking for, ETFs are all about access, and that's why in terms of the range of products that we have thematic equities, as I mentioned there earlier, as well as commodities, or if you want to play the volatility in the currency markets, currency pairs.
So you can be
as
as broad or as granular or as detailed as you wish to a degree.
Absolutely. It's all about access, and it's all about tools for investors to express their investment views.
Okay, now one of the bits of jargon that you may come across is a phrase called smart beta or smart beta, depending where you come from. So in that context, or in this context, where does smart beta products fit into this thematic angle?
Yeah, well, I'm going to use smart beta. If that's
fine,
okay
that's fine. I'll let you off.
Russ.
That's okay.
I think where you see smart beta is actually just a broader, perhaps, explanation of what's happening in the industry.
Please.
Now, I think traditionally ETFs has always tracked, I suppose, passive market capitalization weighted indices. So, FTSE 100 weighted by the biggest companies all the way to.
And the ETF just has that the same weighting, and off it goes.
Absolutely. And then on the other end of the scale, you've got the actively managed funds, where you send your money to an active fund manager, and they manage it for you. Now, a lot of these active fund managers have a bunch of skill sets where they might adjust some of the weights, or they might pick certain stocks within FTSE 100 as an example. But what smart beta does is actually take some of those skills and apply them systematically into a passive or into an index methodology, where, if I had to really sum it up, it's a bridge that I suppose connects pure passive ETFs traditionally and active management in an effort to generate.
And what provides the bridges? Is it a software program, an algorithm, or what sort of provides the mechanism there, or the link?
Yeah, it depends on what the methodology is. Now, smart beta itself spans a whole very wide range of, I suppose, different investment philosophies. And I think design is very important. Investors need to pay attention as to what it's designed for. So, but to answer your question more accurately, it absolutely is about taking I suppose, investment style or method and applying it systematically and seeing it in an index in which an ETF can track.
So besides looking at the index and how that's constructed and how the product then tracks that or responds to it, what other issues do investors need to think about, like say the liquidity of the instrument, for example?
Well, I think earlier, going back to my point earlier, design is absolutely important. Now, liquidity may come into play. Now, it depends. So using my FTSE 100 example again, the most liquid or the most traded stocks are probably some of the larger ones. Now, there's always a concern about what happens when you track an investment where everyone herds into it in and out. There's arguments that you might be buying things that are too high. Now, one of the, I suppose, the strategies of, let's say, smart beta or an active manager potentially, is to not go towards these crowded or herd trades and look for value where
people aren't looking quite so aggressive.
Absolutely. Now, would that affect liquidity? Chances are, if you're looking at a universe within your FTSE 100, unlikely. If you start moving into more illiquid asset classes, that might be an issue, or if you're looking at small caps. But again, bearing in mind, it's all about the design and all about the support behind the ETF product.
And just as a final point, would there be difference in the fee or the total expense ratio related to between a smart beta product and a more traditional vanilla FTSE 100 instrument, for example?
I think what you see in the market at the moment yes, there will be a variation. It'll probably be slightly more expensive just to show the sophistication behind the product. It's there to achieve some of the skills that I suppose fund managers have traditionally.
So in theory, the fee will be more than covered by the premium return that the instrument generates, I guess is the principle?
It's the principle. That's what it's certainly designed
to do. Well, obviously no guarantees, of course.
Absolutely, absolutely.
Perfect. Thank you very much for your time, Howie. Much appreciated. And thank you very much for watching.